Why did the London Metal Exchange cancel $12 billion in trades? Because on March 8, 2022, the price of nickel shot above $100,000 per ton, and the exchange concluded that leaving the morning's trades in place could push multiple clearing members into default. So at 8:15 in the morning, London time, the LME stopped nickel trading. Then it did something even more extraordinary. It cancelled all nickel trades entered on its venues from midnight until the suspension, contracts worth about $12 billion. These were not offers waiting to be accepted. Buyers and sellers had already agreed to them. But if those trades stood, LME Clear modeled a need for about $19.75 billion in additional margin at short notice. If enough members could not pay, the exchange feared a chain reaction inside the system that guaranteed the trades. The LME chose to sacrifice the finality of one morning's completed trades to protect another market promise, that the clearing system would still function tomorrow. Courts later upheld that choice. But Britain's financial regulator also found that the LME's own weak controls had allowed prices to rise faster and increased the danger before the intervention. That is the standoff at the centre of this story. Not trader versus trader, but one promise versus another. If you like stories about the hidden machinery behind decisions that move billions, subscribe, tap like, and ring the bell. Now, to understand why cancelling trades could look safer than honouring them, we need to follow one enormous bet into a market that was losing control. The London Metal Exchange was founded in 1877 and became a leading venue and reference price institution for industrial metals. Hong Kong Exchanges and Clearing has owned it since 2012. Its prices do not stay inside a trading screen. They help set the terms of physical metal contracts around the world. That makes the LME a bridge between factories that need metal and financial firms that trade its future price. For a producer, selling nickel futures can be insurance. If nickel prices fall, the short futures position gains value and can offset the lower price of the producer's physical metal. But if nickel rises, that short position loses value. The producer may still own plenty of metal, yet the clearing system can demand cash immediately to cover the growing paper loss. That demand is a margin call, and it creates a brutal timing problem. Physical metal may be valuable, but margin is due in cash now. Tsingshan, the Chinese stainless steel and nickel producer founded by Xiang Guangda, had built a very large short position. A substantial part of its reported exposure sat in bilateral deals with banks outside the exchange, limiting what the LME could see. Public estimates mix different dates, venues, and types of exposure, so no single tonnage tells the whole story. A producer short can function as a hedge, but the public record does not establish that every part of Tsingshan's position was simply prudent insurance. Then the world became far less manageable. Nickel stocks and deliverable supply were already tight when Russia invaded Ukraine in February 2022, intensifying fears about supplies of the high-grade nickel deliverable into the LME system. But the invasion was a catalyst, not a complete explanation. The market was also carrying a concentrated short position, limited visibility into off-exchange deals, and thin liquidity as Asia traded through the London night. Each weakness amplified the next. On March 7th, nickel opened at $29,770 per ton and closed at $48,000. That rise hurt short sellers. To reduce their exposure, they had to buy nickel contracts back. But their buying pushed the price higher, which created larger losses, which forced still more buying. The escape route was making the fire hotter. Electronic trading continued through Asian hours while the designated senior London decision-makers were off duty. The Financial Conduct Authority later found that overnight staff were not adequately trained or empowered to identify and escalate this kind of disorderly market. As prices accelerated, staff widened and then disabled volatility price bands without escalating the danger quickly enough. Early on March 8th, nickel crossed $100,000 per ton in thin, disorderly trading. Those extreme prints were later cancelled, so they did not remain enforceable LME trades. But before cancellation, leaving them in place would have generated obligations the clearing system had to confront. A clearinghouse stands between buyer and seller. Instead of each side simply trusting the other, the clearinghouse guarantees performance and collects margin to protect the system if someone cannot pay. That structure is supposed to contain a failure. It can also concentrate the pressure when prices move too far, too fast. As prices change, the clearinghouse recalculates what members owe and collects margin to keep yesterday's promise safe today. If one member cannot meet that demand, the clearinghouse can use the defaulter's resources and then other layers of financial protection. But those layers are not infinite. In an extreme scenario, losses can reach surviving members, the very firms the system needs in order to remain stable. By the morning of March 8th, LME Clear modeled a need for about $19.75 billion in additional margin at short notice if the overnight trades stood. This was a risk scenario, not a bill that had already gone unpaid. The model indicated that multiple clearing members could default or face serious default risk, forcing the clearinghouse to absorb losses and potentially demand more money from surviving members. Those demands could weaken more members, producing what the litigation record described as a possible death spiral. Matthew Chamberlain, the LME's chief executive, and other senior decision-makers now faced the real decision point. Suspending trading would stop new deals. It would not remove the giant obligations created by trades already made that morning. At 8:15, the exchange suspended nickel trading. Then, using its emergency power under Rule 22, it cancelled nickel trades entered on its venues from midnight through the suspension. The exchange had not merely paused the clock, it had wound the clock backward. The aggregate contract value of those cancelled trades was about $12 billion. That does not mean the LME lost, paid, or stole $12 billion. It is the face value of contracts the exchange declared void. The cancellation removed gains from traders who had bought before the spike and reduced losses and margin pressure on traders on the short side. In other words, cancelling the trades did not make the conflict disappear. It changed who bore the immediate shock. Affected long-side traders lost gains recorded during the spike, while affected short-side traders no longer owed the corresponding amounts created by those trades. That is why the decision could look like a rescue from one desk and emergency containment from another. Elliott Associates later claimed roughly $456 million in lost net profit, while Jane Street claimed about $15 million. To those firms, the exchange had changed the treatment of their winning trades after the deals were complete. The claimants argued in court that the decision effectively protected Tsingshan. That is the tempting villain version of this story, but it was an allegation, not the court's finding. The LME said it acted to restore an orderly market and prevent a clearing crisis, not to favor one company. The courts did not find that senior decision-makers possessed Tsingshan's full position information and cancelled trades to protect it. That is narrower than claiming the LME knew nothing at all. The Divisional Court rejected the legal challenges in November 2023. The Court of Appeal dismissed Elliott's appeal in October 2024, and the UK Supreme Court refused permission to appeal in January 2025. The cancellation survived the courts. The LME's conduct before the cancellation did not escape scrutiny. Nickel trading resumed on March 16th with daily price limits, while Tsingshan separately reached a standstill agreement with its banks. The exchange also implemented weekly reporting of over-the-counter positions and made daily price limits a permanent feature, while other reforms continued through a broader program. An independent review identified market concentration, gaps in visibility over off-exchange positions, thin liquidity, and weaknesses in the LME's risk framework as contributing conditions. But that review expressly excluded the exchange's March 8th decisions, decision-making processes, and governance from its scope. So it cannot be used as an independent verdict that the cancellation itself was right. Then, on March 20th, 2025, the Financial Conduct Authority fined the LME £9,245,900. It was the regulator's first enforcement action against a UK-recognised investment exchange. The FCA found inadequate systems and controls across the volatile period, including failures in overnight escalation, training, and price band handling. But the fine did not declare the trade cancellation illegal. That leaves two conclusions standing at once. The court said the LME could use emergency power to cancel the trades. The regulator said the exchange had failed to control the road into that emergency. So, why did the London Metal Exchange cancel $12 billion in trades? Because the extreme nickel prices were creating immediate cash obligations that the LME believed could trigger multiple member defaults and a clearing system death spiral. It sacrificed the certainty of one morning's trades to preserve the machinery that made any trade enforceable. That may have prevented a wider failure, but the FCA's later penalty means the ending is not a clean vindication of everything the exchange did. The emergency power was lawful. The controls that allowed the emergency to build were not adequate, and that is the unsettling lesson. When a market's promise to honor every trade collides with its promise to survive, survival can win. Stay sharp, stay curious, and always ask why, guys.